Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields at the high of the range again. So I'm not going to get too excited here. I'm not looking at this as a buildup of momentum. I think that the bond market has been here before. We've seen this 230 to sort of 240 range trade for quite some time. When we do get to one end of the extreme, we tend to gravitate back towards the mean, which is right around 235, which would be the middle of that range. And so right now we're near the high of that, but we have obviously a few obstacles ahead of us that could shift us back very quickly. If you look at market volatility, applied volatility in the Treasury market still remains very low. We're on year-to-date lows, which suggests that there isn't a fear of breaking out of the range. Doesn't mean we won't break out of the range, but there is no fear of breaking out of the range. I think that as higher yields go, the lower vol goes, because it makes bonds more cheaper and more attractive. And when you look at what's going on around the world, yeah, there still is a sort of a flight to quality bid to the bond market in the U.S. And when you look at where equities are on all-time highs, and you look at what's happening in the cryptocurrency markets, and you look at what's happening in metals, there's a lot of uncertainty out there, whether it's being expressed in volatility or not. But there is still a demand for bonds, and that's why when we get to these high yield levels, I think the volatility comes off because there's an expectation that buyers will be there. And if you look at the real obstacle to what's happening with volatility and whether it's bond yields, it's tax reform. And we talked about it, whether relating to the dollar, whether relating to what's happening in equities, whether it's basically touched every commodity that we can talk about, and bond market's no different. But the bond market's in sort of a wait and see mode, whereas other commodities seem to be rallying or outperforming on a positive outcome in tax reform. The bond market is waiting, and it's waiting for something. I don't know whether it's waiting for good news or bad news, but right now it's waiting maybe for ink to hit paper and sign that thing and get us on into 2018, because if we don't get it, there is going to be a collapse in equities. There's going to be a lot of shifting in the dollar, and there's going to be a lot of shifting in gold. Likewise, the bond market is no different. It will be a reactionary market. If things do go as expected, the bond market will probably start to see yields come back, start to climb again north of that 240 level that we just talked about, the high end of the range. But I don't think it's going to happen all at once, because while all other commodities remain on their extremes, the bond market is going to remain a little bit wary and probably err on the side of caution and keep from making a knee-jerk reaction. So right now, bond yields on the high of the recent range, but not yet showing that it's going to be a breakout. We have to wait for tax reform. This is Todd Colvin coming to you from the floor of the CME Group.